Investing. It's the golden ticket to growing wealth. But when you're faced with choices like index funds or individual stocks, the options can feel overwhelming. Do you go the passive route, letting the market work for you, or dive into active investing, picking individual stocks that could skyrocket your portfolio? Today, we'll demystify this debate and help you understand what's best for you as an employee investor, whether you're just starting or looking to optimize your investments. Let's kick things off with a fundamental question. What's the real difference between index funds and individual stocks? Imagine index funds as a pre-packaged meal, balanced, convenient, and ready to go. They're collections of stocks or bonds designed to mimic the performance of a specific market index, like the S&P 500. By investing in an index fund, you're essentially buying a tiny slice of every company in that index, automatically diversifying your portfolio. This makes index funds a go-to for passive investors who want steady, long-term growth without constantly managing their investments. On the flip side, individual stocks are like a custom meal. You choose each ingredient yourself. When you buy shares in a company, you're betting on its future performance. If you pick the right stocks, your returns can far outpace the market average. But here's the catch. Individual stocks carry more risk. If a company underperforms or collapses, your investment could take a big hit. Active investing is for those willing to put in the time, research, and risk to potentially see higher rewards. Now that we know what they are, how do you decide which approach is best for you? Start by considering your risk tolerance. Are you someone who prefers consistency and stability, or are you comfortable with uncertainty for the chance of higher returns? Index funds are inherently less risky because they spread your money across dozens or even hundreds of companies. This diversification means that if one company fails, your losses are cushioned by the performance of others in the fund. In contrast, individual stocks can be highly volatile. Imagine investing all your money in a single company that experiences a downturn. It's a roller coaster ride that's not for the faint of heart. But if you have the time, knowledge, and willingness to weather the ups and downs, individual stocks can yield significant rewards. Think of it as the difference between cruising on autopilot versus piloting a plane yourself. You're in control, but the stakes are higher. Let's talk about time commitment. Index funds are designed to be set it and forget it. Once you invest, you don't need to monitor the market daily. This makes them ideal for employees with busy schedules who want their investments to grow without constant oversight. Individual stocks, however, require active involvement. You'll need to research companies, analyze financial reports, and stay updated on market trends. If you enjoy the process and have the time to dedicate, stock picking can be rewarding. But if your full-time job leaves little room for deep dives into financial data, index funds might be the better choice. Another factor to consider is cost. Index funds are known for their low expense ratios, which are essentially the fees you pay for fund management. Since index funds are passively managed, their fees are minimal, often below 0.1%. Individual stocks don't have these fees, but trading them can come with brokerage costs. Plus, the real cost of individual stocks is the time you spend researching and managing them, which could be better spent elsewhere if investing isn't your passion. Now, let's address a common misconception. You don't have to choose one or the other. Many successful investors combine both approaches. Think of it like this. Index funds can be the solid foundation of your portfolio, providing steady growth and diversification, while individual stocks can be the exciting toppings that offer higher potential returns. For example, you might allocate 80% of your investment portfolio to index funds and use the remaining 20% to explore individual stocks in industries or companies you're passionate about. Here's a practical way to start. If you're new to investing, begin with index funds. They're beginner-friendly, easy to understand, and provide a reliable way to build wealth over time. Start with a broad-based fund like an S&P 500 index fund or a total market fund. These options give you exposure to a wide range of companies and minimize risk. Once you've built a stable portfolio and gained confidence, you can dip your toes into individual stocks. When picking stocks, focus on companies you understand. Look for businesses with strong financial health, consistent earnings growth, and a competitive edge in their industry. Avoid the temptation to chase hot tips or trends. Most of the time, by the time you hear about them, the opportunity has already passed. Instead, Think long-term and invest in companies you believe will grow over the next 5 to 10 years. Another tip is to avoid emotional investing. Both index fund and stock investors can fall into the trap of buying high during market peaks and selling low during downturns. Remember, investing is a long-term game. Whether you're in index funds or individual stocks, patience and consistency are key. Resist the urge to make impulsive decisions based on short-term market fluctuations. Let's not forget taxes. Index funds, especially those held in tax-advantaged accounts like a 401k or an IRA, can be highly tax efficient. Dividend-paying individual stocks can also provide tax advantages, but frequent trading of stocks in taxable accounts can result in higher tax bills. Consider consulting a financial advisor to optimize your portfolio for tax efficiency. In the end, the choice between index funds and individual stocks comes down to your goals, risk tolerance, and the time you're willing to invest. If you want simplicity, stability, and consistent growth, index funds are your best bet. If you're eager to take a hands-on approach and potentially earn higher returns, individual stocks might be for you. And if you're like most employee investors, a mix of both could provide the perfect balance of security and excitement. Investing isn't about finding a one-size-fits-all solution. It's about building a strategy that works for you, your goals, and your lifestyle. Whether you're cruising with index funds, flying high with individual stocks, or crafting a mix of both, the most important step is to start. Timing the market always beats timing the market. So take that first step today and let your investments work for you.